Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis. Taking Stock, episode 32. We've been talking a little bit before the recording started, but I'll ask you again anyway so our listeners can hear it. How are you, my friend?
Chuck, I'm fantastic. How are you?
I'm well. We don't need to tell everybody what we were talking about, but we're both sitting here with a headache
right.
from the discussion. We'll just say it was political nonsense.
Yes, there you go.
Which had nothing to do, for the listeners' sake, nothing to do with the presidential election, just some other political nonsense that, if you let yourself think about it, you do get that headache. But that's not the topic for conversation for Taking Stock today. That's just the status.
How about the fact what a beautiful August day it is out there, and what a beautiful day it was yesterday. It was for August in Cincinnati, and this is Tuesday, August 20th, right? So
son's birthday.
Absolute beautiful. Happy birthday to your son,
Jeffrey.
Happy
birthday,
Jeffrey.
Jeff. Yeah.
Everybody, when you're done listening, take a second and sing happy birthday to Jeffrey.
Right.
There you go.
Unless you're Jeffrey and you're listening to it, and just say, hey, thanks for the happy birthday.
There you go.
We actually celebrated Saturday, but the weather has been outstanding, like you said, for Tuesday, August the 20th, as we sit and record this at midday. Beautiful blue sky, temperature somewhere right around 70 degrees. You can't ask for better in mid-August.
I agree.
So,
yeah. So now I would say, watch this transition.
Go for it.
Things have heated up in the markets, though.
Well done. Well, heated up. I mean, so that's why it's all red, because red is like
well,
hot.
today it's
red
but,
hot.
Yeah, but today's one day. We talked. It's been 2 weeks since the last time we talked.
See?
Yeah, the last time we talked, we had just gone through what I like to, my technical term that you always enjoy is ridiculousness. That was, 2-3 weeks ago, that was, we got an employment report that, once again, I don't think was bad. It just wasn't what everybody was looking for.
Right.
We got...
And we talked about that 2 weeks ago, yeah.
The Fed came through, and they didn't cut rates. Everybody was hoping for a rate cut. And then, we had continued conflict with Israel and Iran and things like that. So that caused the market to take quite a beating over about 3 days. Well, here we are 2 weeks later. Not only are we above where we were on Friday, August 2nd, I believe, if I'm doing the math right, we're higher. We're higher than what we were on that date. So,
I saw the S&P. We were talking about this, very briefly a little bit ago before we started recording. I saw the S&P was at 55.9, which you said already crossed 56 again today.
Yeah. Two weeks ago we were at 51 something.
Right.
And here we are at 5,600 again. So, we talked. I think we talked a lot, 2 weeks ago about there are good reasons for the market to go down, but what was going on 2 or 3 weeks ago was not one of the good reasons.
Well, that was the ridiculousness that you like to talk about. An interesting a question that comes to my mind, whether it's interesting or not, you can decide, and the listeners can decide. But I think it's interesting. We talk about frequently, pay attention to the numbers, and that's what you do, with a grain of salt. Is that right? Because pay attention to the numbers, but they've been kind of ridiculous all over the place because of the ridiculousness. So, what do you say to? Well, are you sure we should pay attention to the numbers?
Yeah. Well, my statement is always pay attention to numbers, but more importantly, pay attention to the trend in the numbers.
That process.
Because you can look at that's what we did. We looked at that number on August
2nd.
Yeah, so let's say it was the 2nd, and then of course automatically the next thing that came after that report was everyone started talking about the impending recession again, and Well, apparently that we took care of that problem within 2 weeks, which is amazing. But you don't really hear anybody talking about a recession today, whereas 2 weeks ago there was the discussion again, and it was just beating the markets down. In a market that, I think you could put an argument that the market was starting to look a little toppy, especially even a few days before that when we were hitting 5,700 on the S&P 500. So, you're a little toppy. You've got some people with some big gains, and then you get some uncertainty or some nervousness inserted into the market, and that's kind of a recipe to make things drop. But what's
a little toppy? I mean, I'm translating that to like a little top heavy, a little bit high in the opportunity for profit taking. Yeah. What do you say? Well, how do you just define that?
So each one of us, we at Jarvis Global, we do all our work internally. So we have stuff that I've developed over the last 30 years, and Caitlin and Austin work with me, and we try to determine based on what our assumptions are for 12, 18 months going forward, where we think interest rates are going to be, where we think corporate earnings are going to be, and all those kinds of things, and try and come up with what we have, really a range of target numbers for the market or for individual stocks or sectors or things like that. But if you're looking at the S&P 500, we talked at the beginning of the year, like really that middle of that range was kind of that 5,400 number. So that was kind of my projection for the year was 5,400. Yeah. Next thing you know, we're at 5,700, which easily puts you at the top of that potential range. So what's the potential upside from what I'm saying is already kind of the top? And so if you can't go up, you're probably going to go down. Okay. Now, I've said it before, with chaos comes opportunity, with volatility comes growth, and that's kind of what happened. We had a real short time period of some uncertainty. We had a little short time period of fear, caused some volatility, caused a little chaos, and looking back 2 weeks from today, it actually provided an opportunity to do some things in the portfolios that maybe we didn't have the opportunity to do 2 or 3 weeks ago.
So the translation of toppy is like projections, the top end projections. So if we get too close or right at or even surpass those top projections, you can look for a drop back toward the middle a little bit. The terminology, and obviously in the financial markets, is a correction.
Sure.
Right.
Yeah. And basically, what we saw over really that 3-day period or so was a I'll use the word normal correction in the market. We dropped 1% one day, dropped 2% the next day, and Monday we dropped 3%. So roughly down 9 or 10%. That's what I would call a normal correction, and I even would describe it as a healthy correction.
Sure,
right?
Sure.
Whether it was warranted or not, we can sit here and argue about that. but that's what happened. So when something like that happens, and we're not sitting here looking at a 2008, 2009 scenario where the interest rates are out of whack and the economy's out of whack and the banking system's in trouble, and those, then that kind of situation, maybe you should reevaluate some things. But that's not the case 2-3 weeks ago in any way, shape, or form.
Well, I love that you say we can sit here and argue that. Because I'm sitting here, my response to that is, I'm the student in Professor Jarvis' classroom. I'm not presenting an argument. If you say that it was warranted, which is not what you said, then it was warranted. If you tell me, the student, it was not warranted, and then teach me the lesson, which you did 2 weeks ago, why it wasn't, in your opinion, a warranted, ridiculous change and drop, because it was driven by fear and greed.
Fear and greed.
I did learn that lesson, Professor.
With a dash of uncertainty, right? Yeah.
Fear and greed with a dash of uncertainty equals
what does that equal? I mean, since we're doing the baking metaphor,
right? Yeah, Well, you're going to have to go with this one.
The recipe for, I think that's a mud pie.
Gosh, what is that? A normal correction cake.
There you go, a correction cake. I like that. Yeah. That's better than mud pie. A correction cake.
Yeah. I had some good fun with mud pies in my past, but it's just, and I say we can argue about it, but there's hundred thousands of me out there, right? I'm sitting here saying this, and there is someone out there saying the exact opposite. I could say, what, we're looking good. Everything I look at, I don't believe the market warrants a major correction or anything like that. But you might have someone else that looks at life and looks at the markets a complete different way, and that's when you start seeing people calling for a recession and things like that, because they look at things in a different manner than I do.
Well, one of the other things we talked about a couple weeks ago was that at the end of recording that day, you were going to work, and going to work that day meant you were going to be responding to some client concerns because of the warranted or unwarranted changes. How'd that go? Just share a little bit of Art Jarvis' day, talking with your clients and helping them understand, to follow your philosophy, to stick with the plan, and to come down off the ledge. How'd that go for you?
Well, I mean, honestly, it went fantastic. Yeah. I mean, it's, I talk to them basically kind of the same way we talk right here. It's like, here's my process. Here's what I'm thinking. Here's why I'm thinking this, and here's how I'm reacting to what I'm thinking.
Yeah.
Okay, and the conversation. If you've been my client for 30 years. You're kind of like, hey, Art, how you doing? Yep, ugly day. I trust you. Just, do what you got to do, right?
And I'll throw in a little endorsement here. I only wish I'd been your client for 30 years. I no, true. Kidding aside, and not just buttering up Art Jarvis and whatever. Mm-hmm. I feel like I might be just that much more better off had I been with this plan with Art Jarvis for these 30 years. I mean, there's no telling for sure, but
sure,
it would have been nice, I think.
Yeah, well,
that's as good of an endorsement as you're going to get.
And one, I appreciate that.
Checks in the mail, right?
Yeah, that's right. Send me money. It's a client. And let's say you're a client that just started last month.
Sure.
Okay, now what you haven't seen 30 years of good returns,
right?
You've seen now. You just started, and next thing you know, let's say we didn't even have them fully invested yet. And let's say they lost 5% in 2 or 3 days. Well, guess what? They're not thrilled. Then that is a much bigger conversation, and get a little more in depth into what exactly we're looking at earnings and looking at interest rates and talking about the peaks and troughs in the market and the things like that. But most. Again, there's a whole bunch of Art Jarvises out there. There's a whole bunch of Jarvis Globals out there. And, hopefully when you hire somebody, number one, you hire them because you trust them. Okay?
Right.
And I say this all the time, this is a big old numbers business, but much more importantly, this is a business and it's about taking care of people. Okay? So, and they say, I love the numbers. I'm a numbers guy. I love trying to put that puzzle together and things like that. But even more so, I love talking to people. I love sitting down in front of people and going through those kinds of things. And it's if you've been with me for 30 years, you've had a 30-year education process. And don't get me wrong, the way I look at things has been tweaked over the last 30 years,
Well, hopefully you've learned along the way as well. I mean, some things change and you adjust with the changes.
I've learned some things the hard way. Let's put it that way. It's
ouch.
But if if that client's only been around for a month, that education is much more further down the learning curve than the person that's been around longer, is much higher up. So, but to answer your question, the conversations were very good. I have a few clients that maybe I try to get ahead of, That I know they watch it much closer than some other clients do. I have other clients, I can call them and they don't even have a clue what's going on, and honestly, they don't care that much. So it's like, just stay in touch with me. Let me know how things
their
are
question.
going.
I'm guessing their question. That client that you contact and say, hey, and they're like, not. So, like, what's going on? We're okay, right?
Yeah,
and you're like, yeah, no, we're good. I just want to keep you informed, right?
Precisely. But then they say, should I be concerned? It's like, no, you're fine. Don't worry about it. Just communicating here, right? So, but no, it wouldn't.
I'm in the Cayman Islands, and your money's gone. That's not it. That's not it.
Let's be clear. Art Jarvis would not do well in prison. So, it's.
Well, let's not send you there, then.
Well, let's not. Yeah, I mean, but it's oh gosh, it's just you just want, a lot of times, like I try and talk to my clients, fairly frequently, at least every couple months for no good reason, but you talk to them, and a lot of times, the conversation is, hey, everything's kind of the same, and this is where we're at, and blah blah blah. But then you have an opportunity, like 2 or 3 weeks ago, that is an opportunity to have maybe a little deeper conversation with everybody, and from my standpoint, you actually get the opportunity to maybe remind them of some fundamentals that need to be brought up again. There's certain things that there's certain things, in my opinion, that again, if we look at investing like a pyramid, there's certain things that I consider the base. Those are the fundamentals. Sure. Those are the bedrock of a good portfolio strategy. So sometimes it's not a bad idea to go back and say, this is why we do this way down here, and then we work our way up to the pyramid to more specific things. So that's a very long-winded way of saying the conversations went well.
That's good. Well, so I want to get into it in a little more depth, just kind of a deeper dive. So you answered that question. What were the conversations like? And for you, that hey, they went well, and I went through. This is what we do. But I mean, I know at least a couple of clients were reaching out because they were expressing some concerns. What kinds of questions, during those conversations? And there's a reason I'm asking this, because we have been begging for questions here on Taking Stock, sure. And we're not getting a ton of questions coming in. So just an example from you in terms of like a conversation like that. What are some of the questions that you hear? I mean, aside from that one that you did mention, which is like, should I be concerned? Right. Well, that's an obvious question, sure. and it's a fair question sometimes. Like, should I be concerned? I'm seeing this happen. Sure. But what are some of the other things?
No, that's okay. And really, what it comes down to is what people are fearful of. Especially if they're older, they're fearful of losing their money. Okay, like I am near my retirement. I'm in my retirement. I'm near the goals that I'm set for myself, or I'm in the goals that I don't want to mess it up, right?
Right.
So really, from a few people, the question is should we be getting out? I mean, that's the specific question, right? Should we be getting out? And to which this past few weeks, no, we shouldn't be getting out. And matter of fact, this is an opportunity, one, to put any new cash to work that we can, two, maybe take some bonds or something that we have purchased and maybe move those back into stock. But more specifically, maybe it's an opportunity to move the portfolio up the risk curve just a little bit. And whether that ends up being a shorter term move or a longer term move, that remains to be seen. But
so up the risk curve, just increase your risk a little more.
A little bit.
Because of
nothing drastic. I mean, we're not going to go from U.S. Treasury bills to buying biotechnology firms that have no earnings and things like that. I mean, it's just, depending on the client. I mean, there's a whole array of things. But, maybe we take a little bit of cash or something that's been sitting in a money market fund earning 5%, and we move that up, and maybe we move it into some large cap growth stocks or some blue chip stocks, something with, higher dividend yields and things like that. So, yeah, you're not going to the casino and putting it on red or black. I mean, you're moving up, and hopefully, And here's the goal. The goal for Jarvis Global Investments always has been and always will be to outperform the market
Right.
with less volatility. So if we can go down less than what the market goes down when it goes down, and we can go up even just a little bit more than the market when the market goes up, we end up not only outperforming the market, so actually earning our paycheck and adding value to the portfolio, but we're actually doing it at the same time as we're smoothing out the volatility a little bit. Okay, and 1 year of that might not be that impressive, but if you got a 30-year portfolio and you do it for 30 years and you're able to, whatever it is, if the market goes down, and let's just say you go down 75% of what the market goes down, but when the market goes up, you go up 105% of what the market goes up, you end up with very nice returns, and you've missed some of the potential volatility that you could have had.
Right.
So,
and volatility there translates to losses.
Well, losses are
and how it went down. But.
Yeah, it's only a true loss if you sell.
Correct.
Right, but you can have what's the word I'm looking for? Book losses on the books. I guess is maybe
Sure.
not even that's not a great way of putting it. You can have paper losses.
I was
going to
say losses on paper.
Yeah, paper losses. So You're okay until you make them official losses.
Well, statements I've received just on my own over the last, let's just say the last few weeks, have shown some paper losses.
Sure.
But I'm not trying to cash out.
Yeah.
I mean, if I had, if the value of my portfolio was A, and then the statement comes and it's B, and B was not, well, let's say the value of my portfolio was C, and I wanted to move to B or A, and it comes back D, well, that's just paper.
True.
Yeah. The next statement comes back and it's B. Well, we surpassed the C where I was and went back up to B, so the earnings increased, and I didn't drop as low as I could have, which is what you're talking about. Steadies or smooths out the volatility.
Sure. Yeah, I mean, if you're looking at a quadrant graph, we're trying to be in the upper left-hand corner. We're trying to be in the northwest corner where there's higher returns and less volatility. So, and over time, knock on wood, we've been able to do that. So, not every single year. I always say, most years we either outperform or we're in the right ballpark, right? But there's been a couple years in the last 30 years where, I wasn't exactly thrilled, and I'm sure clients weren't exactly thrilled either. But in the end, long term, we end up getting where we're trying to get to. You just got to stick to it, and that's people, right? That's people. Some people can tolerate volatility, and that's really. And some people can't tolerate volatility, but that's the relationship that you're putting together. When we first sit down and talk, I'm trying to get a sense from you, where are you on that risk curve? Where are you from a volatility standpoint and things like that? And then you go through some things. You go through a 2008, 2009. You go through a pandemic. You go through a 9/11. You go through a dot-com bubble. That's when you really learn where people are on the risk curve, right? So you can tell me, oh, no, I'm all risk, no problem, all stock, perfect. And then the market goes down 20% and they go down 18%, and they're not happy campers.
Right.
It's like, well, we don't have you where you really should be then. So
that makes sense. Pretty simple explanation of how you can, you haven't had, I'm going to hurt you on this one.
Okay.
you haven't had like the client that was like, oops, wiped out.
No, Lord, no. Yeah. No. Opportunity, dot-com bubble. I've talked a lot about the dot-com bubble lately, and because we talked about the technology sector.
Right, I was going to say, because technology is back at the leading.
Yeah, it's been the big leader.
Away.
It was the leader on the downside. You had NVIDIA, which is the Wall Street darling and still is Wall Street darling. But in that short period of time, last couple of weeks, it dropped 35%. Okay, so that's a big move. Client portfolios don't move 35%.
Thanks be to God, right?
Right. So yeah, exactly. And it's but you look at the .com bubble, you look at the technology sector dropped 80% in 2000. So if you look at and it took 15 years for the NASDAQ 100 to get back to where it was back in 2000. That's a long time.
That's
people we do a buy and hold strategy. I'm like, well, 15 years is a long time to get back to where you belong, right? And then you look at the Great Recession of 2008, 2009. The market over a 15-month period dropped 55%. Okay, our client, knock on wood, and the goal is our clients' portfolios don't drop like that.
Yeah.
Okay, that's the goal. Now, the pandemic, that's one of those years that, you kind of wish, or I kind of wish I had back. As things happened, and it was just looking very, very bad. We made some moves in the portfolio, which at the first were great moves. They actually ended up doing a great job protecting the clients. The problem is then, we pumped $6-7 trillion into the market. Well, the market, the equity markets, did a V-shaped bounce and just took off. Well, the problem is we were still on the conservative side, so we spent a lot of time missing out on that rebound. So if I could have one back, that'd probably be the big one, to be honest with you. But overall, it's worked. So far, it's worked out well.
So if you got that one back, what's the one thing that you would have done differently to maybe give a better result for the pandemic years, we'll call it?
Sure. Two things. One, we've acknowledged the impact of pumping that much money into the economy. There's a multiplier effect. Some industries and some sectors did way better. I mean, look what happened. All of a sudden people are cooped up in their homes. Well, guess what? The building sector all of a sudden takes off. The entertainment sector, gaming and golf and basketball hoops and trampolines and bicycles and all those kinds of things. Those just went through the roof. So, hindsight being 2020, I would definitely be in some of that. But more importantly, two things. One, be back into the market sooner to try and take advantage of that multiplier effect of putting that much money into the economy. The second thing is in 2022, we got hit with inflation because we pumped that much money into the economy. And we've talked about this before. In my opinion, the Fed did a very, very poor job of handling the impact of that much money in handling inflation in 2020. They started raising rates in, let's say, March of 2022. They probably should have started doing it 6 months easily before that, and we wouldn't have the impact on the markets that we had, and they wouldn't have had to raise rates at 0.75% at a time. They could have been much more targeted, and they could have done quarter points and things like that. If they, I always say you got to keep the horse in the barn. Well, in this case, with 2022, the inflation horse, not only did it get out of the barn, it ran off into the neighboring county, and you had to drag that thing back in, that inflation back into the barn. Interestingly enough, here in the last 2 weeks, we got the inflation numbers again. If you're looking at the trend, the inflation numbers continue to work their way down. And for the first time in a very long time, if you look at the consumer price index, it's at 2.9%. So that's the first time it's been below 3.
Right in the neighborhood. Art Jarvis likes it.
Like the 3, but also kind of emphasizes that it still is going to take if we're going to get to 2%, which I'm not sure honestly is a real strong possibility, it's going to take some time.
Right.
Yeah. So.
Well, speaking of time, we're out of it.
Boy, that went fast.
Flying. Well, that horse was running in the field next door. We were chasing it. But listen, Art, thank you so much again. All I do is keep learning. Hopefully our listeners are learning as we go through taking stock. And thus concludes.
Yeah. I'll say one thing real quick. Is you said you alluded to it before. Number one, been very happy with the number of people who are listening. So hopefully it is having an impact on people in some small way. But the other thing is this is episode 32, so we've been doing this for
Well, this is
a while
this
now,
is 32,
right?
right?
32. Yeah. If you have questions, chime in, ask a question. There's nothing more that I would like to get a hold of a question and really kind of do a deep dive on it or something like that. So, but I appreciate people listening. That's for sure.
What's that? So the website is for Jarvis Global. They can reach you there and pop a question.
Yeah, it's www.jarvisglobalinvestments.com.
JarvisGlobalInvestments.com.
Yeah.
With the World Wide Web, www, in front of it.
I don't even know.
Nobody ever says World Wide Web anymore. I just had to just for fun. But no, seriously. And of course, I mean, this gets published on the Loveland Beacon digital news site, so you can comment there and say, "Hey, I've got a question." You can find us. You can share a question, and Art, Professor Jarvis wants to put that professor hat on and answer your questions.
Yeah, exactly.
And
definitely appreciate you, Chuck, and appreciate Loveland Beacon. It's a great opportunity.
Thank you. Well, we'll be back in 2 weeks with episode number 33. Until then, thanks again.
Fantastic. Thank you.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.